Welcome to episode 1 of series 2 of our OR Talks podcast. Today we'll be joined by two special guests, two VAT special guests no less, to discuss overseas VAT, and also we'll be discussing liquidations and insolvency. Here are your hosts, Neil Seeger
and Mark Jovanovic.
So today we are very privileged to have one of our VAT specialists with us. Today we have Jacob with us. So, and we've also got Mark as well. Obviously, Mark's. We're not so privileged to have you though, because you sort of feature every time.
Yeah, I'm not a VAT specialist though, so I'm going to learn a lot here, I reckon.
Okay, well, so we'll find out, won't we?
Yeah.
You might be more of a VAT specialist than you think you are.
Definitely not.
Well, we'll let Jacob do the judge of that at the end. So Jacob, what's hot and interesting in your world at the moment?
So I think the work we do and what we're finding with our clients is land and property seems to be a really key area, and one that's quite complex, quite misunderstood, and it has very serious financial implications if things go wrong, being the nature of it being properties and the values that we're speaking about.
So is that residential and commercial?
That's true. That's both, and that's a good question, because that's what some of the confusion is. So, for instance, for new residential properties, generally the supply is 0 rated, so there's no VAT. Commercial, it's the opposite; it tends to be exempt, and I think that causes some confusion.
So is that just new builds?
Off the bat, yeah, that's right. So that's new build. So if it's an existing residential property, then that's different. If it's a new build, which new is classed as within 3 years, then it will be 0 rated, and anything related to that, to the construction of that, will also be 0 rated. And so what we found sometimes is there can be that confusion about commercial and residential properties. Sorry to interrupt. If I was to put, if I'm just going to put that into my terms. So I'm a builder. Okay, I buy a plot of land. I build a nice new house. Okay, it's lovely, and then then every thing that I buy, so my cement and my bricks and all that sort of stuff, I have VAT on those that I can reclaim the VAT on? Is that so that supply that you provide will all be 0 rated as long as it's linked and it's within the construction phase of the property, then that will be 0 rated.
So what's the difference between 0 rated and exempt then? What's the difference in there?
And this we find as well is a common misconception. So people, from the perspective of the trader, they will just think, well, I'm not paying VAT, so for my purposes, really, it's the same thing. But there's a big difference. If it's exempt, then what it means is whatever's linked to it can't be reclaimed. So any input tax that you can't reclaim when you purchase, whereas if it's 0 rated, even though you won't be charging VAT on it, but you can reclaim for your costs, you can reclaim the VAT that you've incurred to make that supply. And that's the key thing. And also as well with 0 rated, it's very easy for the government, as we realized in COVID-19, to just change the rate of VAT. We had that with the hospitality sector, where they reduce it temporarily, whereas if it's exempt, it requires a lot more work in terms of changes to law, inspections, and policies.
Yeah, so really you want to be 0 rated rather than exempt, don't you? Because you can claim it back there. Yeah, that makes sense.
And also for VAT registration purposes, exempt suppliers aren't considered as part of return on.
Right. So when we're talking about that, so we're talking about the 85,000 there. So we're talking about if I've got, if I'm my sales for 100,000, and £20,000 of that was to be exempt, then I don't have to register for VAT because I haven't exceeded the 85,000.
Yes,
that's put it in sort of Neil terms.
Yeah, that was good maths as well for you on the spot.
Thanks. I'm quite good. I can take 20 from 100 and get 80. There you are. Should be job as an accountant, really, shouldn't I?
The fact that you wrote it down, Neil, has got nothing.
It does to everybody. Well, you worked out for me. So just going back to sort of where we said about the properties and stuff, and the misconceptions that people have. Obviously, what exempt and 0 rated, and we had residential, didn't we?
Yeah.
So more so for the commercial side of things.
Yeah.
If I'm building a commercial unit or buying a commercial unit, what do I need to be aware of in that, and what are people?
So what we usually say is that supply. So oftentimes that will be an exempt supply. So, and what we recommend is if you do what's called an option to tax, then it becomes a taxable supply, and that you can reclaim the VAT you've incurred, charge VAT on it. It gets quite complicated because the option to tax relates to the entity that actually owns the property.
Okay.
So the confusion is, for instance, if you have a property and you sell part of it and the deeds change and the title deeds, people then get confused about what does the options to tax relate to. It doesn't relate to the title deeds and those that separation of the property. It actually relates to the fact that it's the same owner of that particular part of property. The options tax will relate to that. What that means now is when you sell the property, you have to charge VAT on it, but you can recover the VAT that you've incurred. Where it gets difficult is, and for instance, if it's a commercial property and it's been let out with the rent as well, that then you'd be able to charge VAT on that rent. And the confusion sometimes is an options tax is not in place, yet people have for one reason or the other reclaiming the VAT or inadvertently charge rent, and that obviously can be an issue. So my advice really is to seek advice by a competent firm. Like OR. And we specialize in land and property. I have a great colleague, Vic Lucci, and we can give advice on that. And it's really important to get that right. I can't stress that about the option tax. Just the amount of time I speak to clients and I'll have a discussion with them saying, I'm presuming you have an options tax in place, and they look at me
and go, what on earth is that?
Yeah, exactly.
So because what one of the things I've seen, and this probably you see this probably more often than I do, is I go along and I don't know, I'm going to be a mechanic, okay, today. So I'm a mechanic today, and I'll go and buy myself a nice unit, okay. They charge me, so it's I don't know, £100,000 plus VAT, just using nice easy numbers. So therefore, it's 120,000. I go along, and I'm not VAT registered. I'm just, I'm turning over £60,000, whatever. So I'm below the VAT threshold. I'm not VAT registered. I buy the building, and then they come along to us and they say, "Oh, I want to claim the VAT back on the building, on the purchase," but you're not VAT registered.
Yeah.
So you can't claim the VAT back at that point. So what can you then? Can you, if that does happen, can you retrospectively register to be able to claim the VAT back on that, or is that
that's right.
No.
So when you become VAT registered, you can go back 4 years from the date of the VAT registration to reclaim costs on goods, services. It's within 6 months, and that's one of the things that we always check when a business does get registered, and we advise them that that's something to consider as well. And that's why it's very important to have good record keeping, not just for potential intervention and compliance activities from revenue and customs, but just for these reasons, practically to be able to reclaim what's due to you.
So it's not lost then. So I can change my status effectively from a VAT point of view, and still, so I can register today. I bought the building 2 years ago, let's just say. I can then claim the VAT back on that and not have to go back and charge all my customers the VAT on the new tyres that I fitted for them 2 years ago.
Yeah, that's a good point to think about, isn't it? Really, 4 years is quite a long time, isn't it? So there'd be a lot of expenses in there.
I presume not many people are aware of that 4 year thing.
Yeah, and there are conditions for it. For instance, for instance, if they say it has to be stock on hand and it's not completely used up and so forth. The same services, and obviously it has to be for business purposes, but that's something to definitely explore and to look into, and a competent tax advisor will be able to.
Yeah, we'll just go through that. And so that's where they come to us at that point. And we go through the goods and the service and the stock and all those sort of things. But in the big capital purchases, like a building, you don't buy them every year. Well, some people do. And on the flip side of that, let's just say I buy it as the property as an investor. Okay, and it's got the options tax on it. It's all that sort of stuff. So I've reclaimed the VAT. I've registered myself as a VAT, and there's obviously a clear options tax on it. But my tenant that comes in there isn't VAT registered, and then asks me, "Is there any way that you can't charge me VAT?" So therefore, obviously, if I'm still VAT registered, I have to charge them VAT, obviously. But if can I then effectively claim the VAT back on the purchase and then deregister from VAT? So I don't have to charge my customer with VAT.
Yes, that's possible.
Okay, so you can, so it was on my turnover and all that sort of stuff fits that's something, because obviously I'm sure that's one of the people get asked quite a lot if they buy a commercial premises. "Oh, come on, mate, I'm a new trader. Any chance you cannot charge me VAT?" Well, no, because I've got to.
Yeah. So how can you, if you buy a property and it's not got an options tax on it, can you then put it on there? Is there anything that stops you from doing that?
No, it can be done. The only issue is if it's a transfer of a going concern, it needs to be done at the time for that to be considered a transfer of going concern, and then no, that would be due. But generally, when you buy a property, that you can later on apply for an options tax.
It's worth knowing, isn't it?
Yeah, so when we say transfer a going concern, that means transferring of an active business across. Yeah, that's all. Because not everybody else will know what going concerns and then that sort of things mean. So when we're looking at the, it's obviously capital goods scheme and that sort of thing. So what is the capital goods scheme and what does that mean? So
the capital goods schemes list certain items. A good one is that property which is over the value of 250,000, and it's where that there is a recognition of mixed use on the property. So some of it will be business related, some of it will be private. Therefore, that's reflected in what you can reclaim. So obviously, generally speaking, if you have something which is 100% for business use, then you should be able to reclaim fully for it. But obviously, if it's 50-50, then it makes sense that will be apportioned in that way. So that's done over a 10-year period for properties. And so one of the areas here is with commercial properties whereby if when you sell it, it's exempt, and then you have an option to tax in place, right? So then what you reclaimed for it previously, you might have to repay some of that back to HMRC, and that's why it's very important to understand the implications of doing that.
Oh, so what a curveball that is.
Yeah.
It does sound like a bit of a minefield, to be fair. I mean, it does sound like if you've got anything to do with the commercial premises, that sort of stuff, please let us know.
Indeed, yeah, absolutely.
And then I'll ask you.
Definitely, yeah. It's another one of those to be prepared for, isn't it?
Oh, yes. So you'll see this, you'll hear this quite a lot. So Mark's little slogan really he's got for himself now is basically, what is it, Mark?
This is to be prepared, plan ahead.
Plan ahead, yeah. He's got two there now.
I can't emphasize that enough. Just how frustrating it can be to have people retrospectively seek advice and say, I've done this and prevention is better than cure. So we always say seek that advice before you make the transactions and make those purchases, and then we can advise on it, and then you can do it properly, and it will be obviously financially beneficial.
It's always easier to do things to get the advice at the start, isn't it? Yes. And be prepared for what you're going to do.
Yeah, because respectively, you're limited in what you can do then, aren't you? Yeah. Whereas before you've done it, there's options and we can explore those. And
it was on the back full time, whether that be ownership from a tax point of view, from a VAT point of view, from a registration point of view, whichever those things be, we can actually then point in the right direction of where things can be, and actually pull in our specialists that we've got in all the different areas, because they've as a specialist, they've all got different areas. But I wouldn't ask you about the capital gains tax implications, but I'd mark that, but I'd ask you the implication on the VAT. Yes. You might be a secret capital gains tax expert, I suppose. You just kept it quiet.
How many views then? I'll
ask you about that stuff. Yeah. At the end of this, Mark, there's a quiz for you.
Okay, brilliant.
You're making notes. So is there anything else that comes up quite a lot in your world?
So I mean, the one thing now that I think is interesting is from the 1st of January this year, there's been a big overhaul with the regime about penalties for late filings of VAT returns and so forth. And so I think there seems to be mixed opinions on the matter whether it's better now for customers or not. I think it's reassuringly more favourable. It's based on a point system.
So what was it before? You'll have to refresh my memory. To be fair, I don't know what the penalties were before. I knew there were penalties and surcharges and all sorts of nasty things, but what were they? What?
I'd have to refresh my own memory about that. Let's go straight to the new system.
Yeah, so I'm quite interested in the new system, to be fair, because I think it's going to also be brought in for like income tax and corporation tax further down the line, isn't it?
I think the next 2 years.
Yeah, so I'm interested to learn how it works with VAT.
So it's based on a point system. So if you miss a VAT return, then you're given a point in terms, and there's a threshold that you reach where then you receive your penalty of £200. Now the question is, what is that threshold? That depends on the submission frequency. So if it's annual, it'll be 2. If it's quarterly, it'll be 4, and if it's monthly, it'll be 5. So for most purposes, most businesses, they've got within a 12-month period, the threshold will be to reach 4 points that then they'll be given a £200 penalty, and subsequent penalties will be £200 as well.
So I get points. So what do I get points for? Late submission and late payment.
Yes.
Would that be 2 points?
That'd be 2, yeah.
Yeah.
So if I file it wrong. Hopefully I don't file it late and then pay it late. That's 2. I do that for 2 quarters on the bounce. I'm getting a £200 penalty. And then if I then, for the third one, do exactly the same thing again, that's another £200 and then £200.
And then in terms of the penalty as well, it depends on how late it is. So that if it could be up to 15 days, and then you've got 16 to 30, and then more than 30 days, that will determine as well of what that penalty will be for late payments.
So it has changed an awful lot from a straight surcharge point of view, from each quarter's submission or whatever it be, to a point system.
Yeah.
But actually, it gives you a bit of a warning, because if you do either submit it late or pay it late as a one-off, it's one of those things.
Yeah.
But if you're a repeat offender, then you're going to end up getting caught by a fixed sum instead of having a variable which was based on a surcharge, a percentage of the VAT liability like it used to be. It's £200.
Yeah,
£200. I mean, they mount up pretty quick if you keep doing it wrong. I'd have thought.
But it's something about your behaviour over a period of time, isn't it? So
Yeah.
they're going to let you off if it's a one-off. You're going to get away with it, aren't you? But if you're consistently filing late, then you're going to get stung.
And probably rightly so, to be fair. But then you'd like to think using professionals.
So basically, how it works is, for late submissions, it's a £200 penalty, but for late payments, it goes off. It's a different system in terms of what's calculated at 2%, depending on how late it is.
Okay, right. So I see how that works. So yeah, so it's sort of interesting. So you're still with the point system.
Yeah,
it's still exactly that. How interesting. Yeah.
It seems a lot more complicated on the face of it, isn't it? But I suppose once we get into this sort of way of dealing with the penalties,
absolutely, yeah.
It's the same with everything when it first comes in. It's a bit more complicated when it first comes in. The same with MTD, with the submissions, having to suddenly go from this nice little HMRC portal to via a software. That sort of blew everyone's mind to start with, and now it's just submitted through software.
Yeah, it's progress.
That's progress. And as long as you're prepared for it, Mark, it's not a problem. Hopefully, you never prepare for penalties. You always prepare to submit it and pay it on time.
Indeed,
that's it.
Hopefully, it makes everyone's life sorted.
That's the aim.
Yeah, I suppose it makes
record keeping is key, as they say at Revenue and Customs, because it obviously helps to forecast a plan to meet your liabilities, also identify issues and potential problems in the future. But it's obviously easier said than done. I can understand sometimes with businesses, they can, because of their businesses and how busy they are, they can sometimes put that to a side and not maintain good record keeping. But it's important as well, because if you are subject to an inspection by Revenue and Customs, one of the things they'll definitely check is how you maintain your records, how you know what you claim to know. And as a former VAT officer at Revenue and Customs, I can tell you firsthand how important that is, and how useful and favourable it is to the inspector to see that you've made that effort, and therefore your credibility is.
So the key is really through software, isn't it? Because software links to your bank. You can take pictures of your invoices and all that sort of stuff. So obviously I can assume that's quite nice, rather than turn up and seeing a box of receipts and somebody's handwritten piece of paper that they hand over or used to submit.
Yeah.
So obviously it's made everything easier for everybody. People can use your forecasts, as you say, what their liability is going to be, and know at any point what their liability is going to be before they get a scary thing at the end of the back quarter. And then they've suddenly got for 1 month and 1 week to find the money to pay it.
Yeah.
So they can keep on top of that, and also it makes everyone's life easier.
And I mean, like for small businesses, I mean, one of the most common reasons why people don't register for VAT on time is that reason that they don't realize they exceeded the threshold. It's a rolling turnover.
Yeah.
They didn't have good record keeping in place. They had certain surges or spikes throughout the year that were unpredicted, that have caused them to exceed the threshold. And it's important to therefore have good record keeping to avoid that, because obviously then if it is a late registration, you could potentially get penalised for that, and all these things will be taken into account when they're determining what the penalty would be.
Yeah, I mean, it causes loads of issues, doesn't it? It causes you to pay your penalties, and it also causes you have to go back and charge the customers you hadn't charged VAT, because all of a sudden you now should have charged the VAT. You hadn't realised you had to, and then it's a really embarrassing situation for everybody at that point.
Doesn't make you very popular with your customers either, does it? So you want to avoid that.
Particularly not if it's a £100,000 invoice.
Yeah.
You've got another 20 grand.
But,
not really.
Yeah, touching on your background there, that's quite a useful experience for us to have as a firm, isn't it? You knowing what HMRC will be looking at and things like that, and things to look out for.
Absolutely, yeah. I think that's why I'm a valued asset to the firm. I'm quite, that's what I certainly bring to the table. This month I've been involved with 2 clients who are subject to compliance checks, and due to meet with them to kind of go through their records, explain to them what you can expect to be looked at, what are potential high risk areas prepare them well for it. And I think that's really important and useful to have someone who's just made the transition so recently.
Yeah,
100%.
it's invaluable, I think, isn't it? You
Yeah.
can reassure people about what the process is going to be like and what they're looking at, what they're going to ask.
There's nothing better than having somebody come for a pre-inspection inspection who happens to be an ex-inspector. So thank you, Jacob, for being with us, and thanks for answering our questions and bringing your hot topics to us.
Yeah, thank you. I've learned a lot there. So yeah,
thank you. So our new VAT inspector is Mark.
Not a chance. I'll stick to my tax. I'll let Jacob keep the VAT. It's not my area.
So next we have with us, so Vic is also one of our VAT geniuses. So Vic, so thank you for being with us today.
Thank you for the invitation.
So well, we'll see how we feel in about 10 minutes time.
Yeah, you might not be saying thank you after.
So Vic, so from your point of view, obviously we've heard from Jake and how and you know how what's going on in from Jake's point of view. So from your point of view, what's a hot topic? What's hot in your world?
We need to look at all the changes after Brexit, especially for the companies that are still doing transactions in Europe.
Okay.
So there are a lot of changes, and I will separate because let's have a look first at business to business transaction.
Okay.
So if before, when we was in EU, we are having for goods, intra-community supply of goods or intra-community acquisition of goods. Now, if you are selling in Europe, you are doing an export of goods, and if you are bring goods from Europe in
They're importing
UK,
goods.
you are importing goods.
Yeah.
The best thing is that we have the postponed VAT, and this is a good point for the company cash flow.
Yeah.
So no need to pay VAT and wait to get the refund.
Yeah.
We have the reverse charge mechanism for postponed VAT in the VAT return, and it's easy for the company to deal with his cash flow.
Yeah.
Now, before Brexit, the main advantage being in Europe and doing transaction with other European companies, there are a lot of simplification rules like triangulation transaction or call of stocks, depending of the business activity of the company. So now, for example, if you want to buy some goods from Italy and your client is, your customer is situated in Germany, and you will not do an import in UK and export an import of the goods from Italy in UK and export of the goods from UK to Germany,
even though the goods haven't touched it, even if the goods haven't touched it.
Yeah, you will have to look into get a VAT registration in Europe and still use the simplification rule.
Oh, right.
Triangulation with the triangulation transaction. So if you get a VAT registration in Ireland, for example, using the simplification rules like triangulation transaction, you can move your goods from Italy to Germany without any VAT implication.
Because they're still both in Europe.
Yeah.
Right. So so the key is that we're not anymore, and the people I can imagine forget that quite a lot.
Yeah. To get the VAT registration in another country in the EU, do you have to have an establishment there, or
No?
No?
You can be non-resident. No need to be established, and you can only register for the VAT purpose there.
Okay, that's quite interesting.
Yeah, so that makes things a little bit easier, doesn't it? So you could be a UK registered, say, limited company and have VAT registrations in Germany and in Italy and indeed here. You know, obviously you should have it anyway if you're dealing with VAT.
You've got it here.
So this is the easy solution to get an European VAT registration. But if you are doing transaction without seeking for advice before, you'll you can move the goods from Italy to Germany, but your Italian supplier will charge you Italian VAT on the invoice, even if the goods leave Italy. And are the place of supply is in Germany. So you will have to get a VAT registration in Germany, doing an intra-community acquisition of goods. And you'll have to sell the goods with German VAT.
So what I can't do is I can't be a UK registered limited company, do my buy my goods from Italy, say sell them in Germany. So I can't reclaim the Italian VAT on my VAT return in the UK and then charge UK VAT to Germany and just forget all that, can I? I'll have to do it, register properly.
Yeah, what it is interesting now after Brexit is that some European country have some agreements with the UK, and it's more easy to make business in that countries. But for example, we don't have any agreement with Italy, so if you are buying goods without being registered in Europe from Italy and want to move or to sell in Germany, your Italian supplier will invoice you with Italian VAT. And in order to be able to claim back that VAT in Italy, you will have to get a VAT registration in Italy. And the main condition is to prove that the VAT that you are claiming, it's part of ongoing transaction in Italy. So it's not, if it's one-off transaction, you will not be able to recover the VAT. You need to prove that you are doing business in Italy and it's ongoing business in order to get the VAT registration. And
that's what's so important to contact specialists, isn't it? Because you know, well, I wouldn't know, to be fair, who we got agreements with, who we haven't got agreements with, and I wouldn't have known. I would have just thought, well, it's a transaction in Italy, whether it's a one-off or not. I'm going to register, and then, but you can't do that either. So that's why it's so valuable, as we said when Jake was with us, that you know that it's so important to contact specialists, because that's what you guys are fantastic at, isn't it?
So, as a UK company, is there any country in the EU in particular that's best to register for VAT in, or does it not matter?
It's matter because there are 27 Europe countries, So, for example, if you are bringing goods outside Europe, in Europe, the best place to do the imports of the goods, it's in the Netherlands. They have a lot of, Article 23, and you can postpone VAT, no need to pay. So it will be a good point for your cash flow. And from there, you can distribute your goods everywhere in Europe.
Yeah, see, this is things that's worth coming and speaking to us about, because I wouldn't have known that.
Now, from 1st January 2022, we also have this postponed VAT in France. So it's another good country, another option to looking for some simplification rules and make your business more easy in Europe.
And that just shows how it's changing as well then all the time. So it's always worth seeking new advice, even if you think you've sought advice in the past and you think you know it. It's always worth double checking that nothing's changed, because you're able to keep up with it. Like we wouldn't be able to, would we?
Oh no, absolutely not. No, it's the same as your tax. It's always changing. There's always things changing. It's you know, invaluable, I say, having experts like you guys to sort of help us with these sort of things, to be honest. Well, I mean, there's only so much Googling you can do. You know, Google tells porcupines sometimes.
It takes you down some bad roads as well.
It does tell you some things that you shouldn't, some things that you shouldn't, and some things that you should do. And so I'm not being dragged in. I'm not being dragged in by you.
And you need to be sure that your source of information is correct and accurate, because there are a lot of changes every day.
Well, you know, you might find a page that was on Google from 3 years ago, which is now no longer valid because there's been 2 or 3 changes since that.
And anyone can put anything on the internet. Doesn't mean it's true, does it?
No, you have to have a qualification to put things on Google.
Exactly.
Well, you did.
Better to ask before
And
doing something.
it goes back to Jake's side of things as well, doesn't it? That, you know, when we're talking about, you know, doing something, or you're looking to do some trade, and, you know, looking to buy a commercial property or do some trade in the EU somewhere, and or even outside the UK, it doesn't matter if it's in the EU, that you've got to check with, you know, what the things to be aware of are.
When we are talking about land and property, the base of VAT rules is that the VAT is applicable where the land and the building is located. So
Again, you know, it's one of those. You're going to go and buy a premises in Spain, for example, not a holiday home, but, you know, a business premises over there. Then, you know, it's been aware, and, you know, their rules again for like holiday homes or that sort of stuff will be different to ours here. Their VAT rules, will be different to our ones here. Well, I assume that. I'm not a Spanish VAT expert or tax expert, but I'm assuming they probably are.
we are working with a lot of external consultants. So if we have with one of our clients this kind of situation, for sure we'll be able to advise him and guide him to do the right things.
Yeah, that's it. We have contacts in all different countries, don't we? That we
Yes.
can go to. So
We are part of the Morrison network, and we have specialists all over the world, not only in Europe. So when we have a query with one of our clients and it's outside the UK, we always get an external consultant to guide us.
Yeah, exactly. And the amount of people that, you know, accountants that I've spoken to that will just do that stuff on Google.
Yeah,
they will Google what the rules are in other countries, which is, I mean, obviously we are privileged that we are part of the Morrison group, so we can actually, you know, speak to, you know, I had one a couple of weeks ago, which is an American issue, and we spoke to the American accountants.
Yeah,
you know, and their rules are very, very different over in America. So, you know, so it's handy having those sort of people. Not only have we got experts in house, we've also got overseas ones that we utilise via our network.
Yeah, it's good, isn't it? It works both ways. So we get referrals from them as well, from all over the world.
Yeah,
people dealing with the UK issues. So
it's a good partnership. We all sort of work really well together as well. It is, you know, I can tell you from my experience with them, it works spot on with overseas accountants and tax advisors. So within your, is there any other things that are cropping up?
Yeah, so we only talk about business to business transaction now. Let's have a look at the business to consumer transaction. Yeah, when a UK company is selling goods to private individuals, where in UK we'll have UK VAT, it's easy.
Yeah.
But if we are selling these goods in Europe, for example, what are the VAT rules? What the
Let me just Google. Let me just Google.
You'd assume you charge UK VAT, wouldn't you? That would be.
Now the question is where the stock of goods are located. Are in the UK or in Europe? From where you are selling these goods?
Okay.
So if they are in the UK and you are selling in Europe, you need to look. So you can go and register in each European country, which is the hard thing to do.
Yeah.
But now from 1st of July 2021, we have the import one-stop shop VAT registration, which helps you to sell your goods, which are outside in Europe. But there are few conditions. For example, the value of the goods to be equal or under 150 euro. And if your goods are within this range, 150 euro, you can sell the goods and report one return. It's monthly return, but it's easy that you can report all your sales in all European countries in one return for all 27 countries.
Fantastic.
Now, if the value of the goods is higher, you will have to look maybe to find a European country where you can have a warehouse and have your goods moved there. Because you will not be able to apply, because for import one-stop shop for goods under 150 euro, you will not pay any VAT for
Right. Okay.
selling your goods there.
Yeah.
You only need to collect the VAT from the country of dispatches. Yeah.
Yeah. Okay.
That's quite a low threshold, isn't it? 150
Yeah.
euros, isn't it? It's not high, is it?
No, it's equivalent of £135 here.
Yeah.
So
No,
That's what you're selling.
this
If you're selling hoodies, then you'll be fine.
depends on the hoodies, doesn't it?
Well, yeah, if there is not, yeah, very. Yeah.
From shopping where you shop, then you have 135 probably won't get me
No,
one.
you wouldn't buy your sock, to be honest. £135. But yeah, it depends what you're selling,
Yeah.
doesn't it? And you know,
So if your goods, the value of the goods are higher than €150, you have two options: looking for to sell on the online marketplace, and there are two types. When you are selling direct on the website, the
Yeah.
goods on the online marketplace, or when you are selling the goods through the online marketplace and they are selling direct to the final
yeah.
Yeah.
customer the goods. So if you are selling through the online marketplace your goods and you are selling direct, you are it's your responsibility to collect the VAT and pay to the
Pay to who the relevant authority.
yes, where you get the VAT registration. But if you are selling direct to the online marketplace, the VAT responsibility is with the online marketplace, not with you.
So it's probably easier to
It's
sell
easier,
on marketplace.
Yeah.
Well, they might pinch me a profit though. That's
Yeah,
That's the
because
downside.
a lot of,
yeah.
uh,
Pros and cons.
for example, Amazon has warehouse everywhere in the world. Yeah.
Yeah.
Especially in Europe. So you can move your goods there in the Amazon warehouse, have a contract with them, and now depending how it's better for your business, you can sell direct to Amazon and they will sell direct to the final client, or you can choose to sell on their website.
And do it yourself,
Yeah.
sort of thing. Yeah.
But you need to think about the VAT responsibility.
And I'm sure most people don't.
No.
They will just think I'm selling a product and that's it, and bury their head in the sand.
Yeah.
And then come to us and say, I've got a bit of a problem. I had a letter come through. You won't believe it, but I don't quite know what I'm doing with this letter. And then we've got a problem, because then you've got to try and retrospectively register in other countries that aren't necessarily probably easy to register in.
Yeah. So how I say, if you have the warehouse with the goods in UK, we can looking for import one-stop registration and sell the goods under €150 in
Yeah.
Europe. But if you are thinking to move your goods, or maybe your goods are already in Europe and you want to sell to private individuals in Europe, so you'll have to have a normal VAT registration in the country where the warehouse is situated, and you'll have to have a one-stop shop VAT registration. What is with this one-stop shop registration? Before Brexit, we had the mini one-stop shop, which was only for electronic services. Starting with 1st July 2021, we have one-stop shop, which means that all the electronic services can be reported through this VAT registration. And now the best thing is that you also can include in this VAT return the goods. So we have services and goods to private individuals.
Yeah.
If before each European country had a distance sales threshold for the goods, now we have a European threshold for both goods and services, which is €10,000.
Right.
So-
Okay. Yeah.
It's more easy to get one VAT registration and collect and pay the VAT in
Definitely.
one time for
Yeah.
all your sales in 27 European countries.
Yeah, definitely. It does sound like a bit of a minefield, to be fair.
Definitely, yeah.
You know, and I would like to claim that I've got half an idea. But if people haven't got any idea and this is not anywhere near their specialism, then please shout. Please come and see us.
Yeah. I think the key message is if you're dealing with Europe, get in touch and make sure your VAT live responsibilities are all in line.
Yeah. And then let people like you be who decides, not you, Mark.
Yeah, no, not me.
Not decide actually what needs to be done, and then take that sort of onus off them a little bit.
Yeah, so our advice is to seek for advice before doing something, because it's more easy to prevent than treat.
Absolutely. What's the motto, Mark? Always prepare. Always. The more you prepare, the easier things are for both of us. For us as accountants and you guys as clients and you guys as advisors. Really,
Yes, there are a lot of solutions, but we need to know exactly what is the business activity, what you want, what you intend to do in the future.
Yeah.
And in this way, we can find the best solution. If you already done something, it's a little bit hard to correct. Even if you correct, you can have you can lose some VAT, and you are not able to recover. If it's something from Italy, it
can be an expensive mistake, can't it? It can be a very expensive mistake to make.
Yeah.
Yeah,
so it's better to, when you are, when a company is looking to extend the activity outside UK, not only in UK, outside the UK, you need to seek for advice and
absolutely
prepare to know exactly what you have to do.
Yeah. Your phones will be red hot after this. It'll be non-stop. Everyone will be like, well, I'm going to Europe. Hopefully. Anyway, hopefully for us, but maybe not for you. Having a red hot phone. but yeah, I actually haven't got any more questions, to be fair.
No, nor me. I've learned a lot there as well. VAT.
That's it. Well, when no one's listening, we'll ask you which one you learn more from. No, but no, I've learned an awful lot as well. I didn't know half the stuff, to be honest, that you guys have said, so we sort of really appreciate it.
Just come and ask.
That's exactly. And that's the message to me, let alone to clients.
It's so easy, just come and ask, because if you understand and have the full picture of the business activity, it's easy to find solution.
Yeah.
Sort the things and save some money.
And that's why it's so good having the specialists that all work together, because I'll understand the business, let's just say, and obviously Mark will understand the personal tax and corporate tax and crypto tax side of things, and then obviously you coming with the VAT, which helps us immensely, really.
Yeah, we have all tax in one place, and
we have a tax one-stop shop. Yeah, team one-stop shop. There's our new strap. So all inclusive.
Yeah.
I know that'll give you the wrong idea. People turn up with their wristbands.
Turn up at lunchtime, don't they?
Got a wristband and chance with ice cream. And then I've got to think, well, where's the ice cream come from? And where am I selling it? And I'll go, Vic, what do I do with this? Where am I charging VAT? I've got my ice cream from Italy. What do I do? So no, but I really appreciate you spending time with us today and educating us on
thank you
the
very
European
much.
side. Thank you very much.
So thanks to Vic and Jake for their knowledge on VAT. I think we've both learned an awful lot on that.
Definitely, VAT is not my area, so yeah, I learned a bit there.
Especially about the overseas stuff, it was absolutely mind-blowing, to be honest. And it's something that I'm quite glad that we've got people like that around who can ask questions.
That's what we always say, isn't it? We've got specialists in every area, so it's
in every area, and also it's good to be prepared. Prepare for that overseas stuff.
Still in my saying there.
It'll be on my t-shirt in the club shop now. That. So, following on from the VAT, one of the things that comes up more so in probably my world than your world is the liquidations and going sort of liquidations and closing the business down and all that sort of thing that comes with that. Have you come across that much in your world?
A little bit. I say it's more in your world, though, isn't it, with the account side? But this is I'm going to enjoy this. I get to grill you now.
That's so much to change, isn't it? I'm normally the one that just sits there and dosses and just sort of asks everyone else questions. Yeah. But yeah. So go on then. Fire me a couple of questions. What
What have
So
we got on liquidation?
let's start with, what is a liquidation? What does it mean?
So in simple terms, liquidation is effectively just the closure of a limited company. So this is more for limited companies. Obviously, if you're a sole trader or a partnership, it's more bankruptcy, and we're not going to get into that side of things today. It's more just looking at liquidations of limited companies. So it's about the closure of a limited company, basically selling the assets and dissolving the company off the official register, so off Companies House.
Okay, so yeah, when you've come to the end of wanting to have your company and you want to shut up shop, for instance.
Yeah, I mean, there could be a few reasons why people do. It can be that that effectively the business has come to the point where it no longer needs to exist. There's no one to take on. There's no succession plan there. It just finishes. There's other sides to it where, you know, there's the company's got debts and the trade has disappeared. So therefore, they have to then close their business for that reason.
Got you, yeah. So are there different types of doing it then? So if you owe people money or whatever?
Yeah, there are actually 3 types of liquidations. There's a creditor's voluntary liquidation, CVL, which is where the company is insolvent and no longer has the ability to trade or the ability to pay its debts. And in this case, the directors instruct the insolvency practitioner to come and take over control of the business and then to liquidate it and help maybe settle some of those debts.
Got you. So it's a bit like what happened to my Worcester Warriors with HMRC money.
Yeah, exactly. And then you get winding up orders and all that sort of side of things. That's where they come in. The other type is a members voluntary liquidation, MVL, which is where the company is still solvent and has the ability to trade, yet the directors of the company wish to close the company down. In this case, they'll also approach an insolvency practitioner to close the company down. Okay, so there you see that when you see companies restructure. So they want a branch they don't need anymore. They want to, you can effectively, you can close a limited company down by what's called a strike-off option. The strike-off option is great, but what that means is it still sort of exists in the background. It can be, if a creditor says they're owed money and actually the company shouldn't have been dissolved, then they can effectively make the company be what's called resurrected. That's another type of thing where actually once a company is liquidated, it goes through once a company is coming to liquidation or those sort of things happen, they go through an insolvency practitioner, and that person is an independent person of the company. He might be an accountant or she might be an accountant or, but they're independent people that look at the books, look at what's happened to the money, look at where things have gone and why hasn't that company got the ability to pay loans, to pay those sort of things. And if they've taken the loan and put it and bought themselves, the directors bought themselves a Ferrari and the shareholders, then obviously that's not using the money for commercial reasons. So therefore that they have to verify that the money is being used. Actually, it has just dried up as a result of trade. Yeah. And at that point, because it's dissolved from the register and somebody independent has said it's got no money, then it can't be resurrected. No one can have a claim on that anymore. It's done. Yeah. So it's like an independent audit of what's gone on, basically. Yeah. They've been dodgy. That's it. Yeah, to make sure everything's above board and whatever. And they're regulated, the insolvency practitioners, by their regulatory bodies, and they obviously have to sign to say everything is above board. The other type is a compulsory liquidation, so not voluntary, compulsory. And what this is where a creditor approaches an insolvency company to come and take over the company, as the company no longer has the ability to pay the debt, so it's missed the payment, and this is where you see the winding up petitions. Got you. That all sort of makes sense. So it sounds a bit messy and sounds a bit funky, but effectively, if the company's solvent, so when I say solvent, it means it's got positive balance sheet, and it's still got sort of cash in the bank and whatever, and it's still okay to continue. They just decide it doesn't. And the other side, you've got negative balance sheet and no cash. Then effectively, that's when the creditors can potentially get involved. Okay. There is effectively what's a compulsory. Well, I was touching it a second ago, which is the compulsory liquidation, and that's where effectively like what happened to Worcester Warriors with their winding up orders from HMRC, and that's generally part of an insolvent company, so the company hasn't got enough money to pay its debts. You get a winding up petition come in from HMRC. You see them quite a lot now, actually. To be fair, particularly you hear them in the press from HMRC. You don't hear from anywhere else. No, they tend to go after high-profile names, don't they? Well, yes, they don't come after the small fry ones. But again, that would still have to go through, the insolvency practitioners, the administrators, those sort of the people get involved then at that point.
Brilliant. Okay. So when you're in liquidation, then can you carry on trading?
So once it's in liquidation, basically it's ceased to trade. So as soon as the decision's been made to liquidate, that's it. It stops. Okay. So basically as soon as the decision's been made, generally, if the company's insolvent, you can't trade insolvent.
Got you.
So at that point, and if you are caught with that, then you can get yourself in a bit of trouble. And you can also be caught if you're trading insolvent and you're taking money out that realistically you see as dividends. Then if you go to liquidation, then you've got to pay that money back.
Yeah, you can't pay dividends if the reserves aren't there.
Correct. That's it. Yeah. So you are at that point, you are trading insolvently, and you shouldn't be doing that. And if you are caught doing that sort of things, or the insolvency practitioner or anybody sort of, you get convicted of that sort of thing, that can carry a prison sentence as well. That is a criminal offence.
Prison as well. It's quite serious then.
Yeah, very, very. Yeah. That can actually you can actually get prison worse case without trying to scare everybody on here. But also you can be banned from being a director for up to 15 years. So so trading insolvent on that sort of things can get you in a bit of trouble. So it's something really, if you are considering closing your business down, for multitude of reasons, really, it's worth speaking to the insolvency practitioners and actually finding out their view before you click the button to go and liquidate. Because if you go and liquidate and you owe the company, say, 15, 20, 30,000, you've got to pay that back to the people you owe money to.
Got you. So for instance, if you've got an overdrawn director's loan account, that would have to be repaid.
Correct. Before, and if you try and liquidate whilst you've got one, the liquidator's going to turn around and say, any chance we can have the £15,000 back? And at which point, if you haven't got that £15,000, that's when you start looking at your personal situation. That's where you might go down the bankruptcy route. So it can spiral out of control quite quickly. But really, if you are in those sort of situations, the liquidation, the insolvency practitioners are really important.
Got you. So it sounds like you need to do some forward planning and
forward planning. There you go. Forward planning. There we go. It's there. It's there. And those. It's, as I say, it's something that's worth considering if you are in a position.
Yeah. Got you. So what are the advantages and disadvantages of a liquidation then?
Well, there's a lot more advantages and disadvantages that come with it. So the main advantages are it removes obviously the pressure of being it removes the pressure from the director being chased by people for debts. Obviously, that's first and foremost. As I said, if it's an independent person is signed to say that company's got no money, it stops there being a chance to chase. So if you were to just close your company down, just effectively strike it off the register by yourself, you don't have that sort of protection that comes with it. It allows time basically for you to be able to sort of for somebody else to be able to collect in the money from the assets and offset that against the debts that are sat there. It allows the opportunity for the directors and or shareholders to purchase the assets off the company at what's called a fair value. So the liquidator or insolvency practitioner will agree that's a fair value for that car or whatever.
I was going to say, so if you've got a car in the company that you want to keep afterwards, you can buy it off the company. Yeah,
correct. An agreed value with the liquidator. So it's an independent person that's come in there that's, and then therefore, so you might liquidate, say, I don't know, company A and want to continue because company A hasn't worked out or whatever, but you want to then, go into company B to continue the trade. Okay. You might be in there, let's just say it's me and you, our business doesn't work, but actually I think that I can make it work by myself. So what you've done in the business and hasn't necessarily worked. So we want to go off, I want to go do it myself, but I want to buy the machines. But the machines aren't owned by me and you, they're owned by the limited company. So I can then agree with the liquidator to be able to buy them up at an agreed rate and then go into my own company and continue the trade.
Got you. Okay.
So it offers a clean break. So at the point the company's liquidated, it's effectively like sort of completely gone.
So all the history, like there can be no claims.
There can be no claims, no. Yeah. So it's gone at that point. And the company's got no money. The company's struck off the register. The company's gone, and the directors are free to go off and do what they want to do. And also, it's quite an interesting one is if you've got employees.
Right.
Well, if you go and liquidate, it gives employees a chance to claim redundancy from what's left within the company, and also there are government schemes available to be able to claim that. Okay, so the business, so effectively their job has gone at that point.
Yeah.
So they can therefore access the government schemes.
Yeah, it's a good point that. So when you talking about liquidating, it's people's livelihoods, isn't there, that you're talking about, isn't it?
It's not just the shareholders and the directors if they're a small owner managed company. It's the employees. Yeah. It affects a lot of people. So yeah, and also when if you do, then the liquidator's costs are paid once the company assets are sold. So the liquidator gets paid out of effectively what's left within the company.
Okay, yeah, that's a good point, isn't it? So having a liquidator does bring in those costs as well that they're going to charge the company for doing it.
Yeah, they charge the company, not the directors, because the company's going in liquidation, not the directors.
Yeah. Again,
same as bankruptcy. Bankruptcy is an individual, liquidation is a limited company. So they're not going bankrupt, the company is realistically. So therefore, any fees and whatever relate and are charged out of the limited company's pot. So I know what you're going to ask me next, but I'll let you ask. Go on.
The disadvantages then, we've heard a lot of positives there.
Yeah, there's an awful lot of positives. But obviously, as there was always a spin-off of what the, what are the bad side of things. Well, obviously, we said earlier on that the company can no longer trade. Well, once the liquidation process started, it can't trade as ABC Limited, ABC or whatever. ABC Limited has ceased. So therefore, you can't trade as ABC Limited anymore. Or as a similar name really, so you could do ABCD Limited, but you couldn't have ABC Limited. Right. Obviously it's one of the same thing, or even pick up the name, because once that company's in liquidation, it's the name still exists, but you probably wouldn't want to use the name of a company that's liquidated.
Yes, the reputation's probably not going to be there, is it?
Potentially not. Depends if it's a solvent or insolvent one, I suppose, isn't it?
True.
Once the liquidation starts, any trading that has continued that business, basically, if you continue to trade with that business in liquidation, you can be prosecuted. Okay, that can be sort of not being allowed to be a director anymore. That can be penalties, which whatever whatever the standards are at that time. But you can get yourself in real trouble continuing to trade through a liquidated or a business in liquidation. And the assets, and then the assets, reputation, licenses, anything to do with that will actually be removed from company ownership. So you can actually lose things you've built up. So if you've got patents, if you've got those sort of things that trademarks, they will
go with the company.
Yeah. And but the liquidator could at that point try and sell them. So the liquidator could try and sell them to anybody could then buy that off. They could go to open market. They could go wherever. So you have got the opportunity to buy it, but it could not be at a rate you can afford.
Yeah.
So yeah, and also any tax losses you've got that of existing in that company disappear.
Lost.
So yeah, well, they belong to the company, don't they? Yeah. The company's losses, so they just completely go. You've got no way you can get those back.
Yeah, I suppose the company won't be doing tax returns going forward, will it? So
it's not trading. Well, it shouldn't be trading. That's where you get prosecuted. So you've got to really think. You've got to be very proactive. If you're going to thinking of liquidating a limited company which has got tax losses, you should really consider the situation of those tax losses and if anything can be done with them before you liquidate. Yeah. Because once you liquidate and press the button, those losses realistically are gone, because a liquidator is not going to try and realise a tax loss. He can't.
No, there's nothing you can do with it.
Can't sell it. Obviously, it's not nice to have losses, but if you've got a successful other arm to your business and you want to try and utilise those,
within the group,
you want to prepare with, don't you? You want to prepare before you liquidate.
You're living this here now, aren't you?
Yes, I'm just catching it off you. I think I don't know what's happening to me, to be honest. I think I'm just. Spent far too much time with you. That's the problem.
That's it.
So I've mentioned all the good things. Yeah. And all the bad, most of the bad things, but there are some other little bits that exist, things called bounce back loans.
This to do with COVID and everything.
This is back to do with COVID, yeah. So during COVID, I'm sure most people saw that the nice things went out there, and they were called bounce back loans. So the idea of those were you could take a loan that was government backed from the banks based on your turnover.
Got you.
So what you could do then is you could borrow up to £50,000, and obviously it's a loan, so there's no tax net at that point. Have the money in the bank to help you effectively bounce back from COVID, to help your cash flow.
Yeah, so they were giving these out relatively easy, weren't they?
Yes.
Because they needed to get the money out there so quickly.
Yeah.
It was backed by the government. They were quite flexible.
It was not like form, wasn't it?
Yeah.
So so though, but at that point they didn't ask you for any backing. They just asked you what your turnover was.
Yeah.
And that was all they wanted. I'm not going to go into Sybil's loans because that was a slightly larger amount. But most limited companies that I deal with on a probably day-to-day basis have got bounce back loans in them.
Yeah.
And speaking to a couple of liquidators, they have said that most common, or in fact in every liquidation at the moment they're seeing bounce back loans. This actually made me this is quite common apparently, and I couldn't believe this, to be fair. People somebody a couple of weeks ago tried to liquidate, having taken a bounce back loan in their limited company. The limited company had sales of £2,000. So £2,000 wouldn't be enough income to be able to borrow at the time, the 50,000.
Yeah.
They borrowed the 50,000, took the money out of the limited company. So not only have they borrowed the money on turnover that they didn't have, they've also taken the money out to go and buy themselves a nice sports car. Oh. Well, unfortunately, they weren't able to liquidate because they've had to pay most of the £40,000 back. Well, they were able to liquidate, but they had to pay back the money for the loan they took.
So he's had to sell that sports car.
So he's had to sell. Well, I assume so. We didn't go into too much detail on what happened. But yeah, so they've been tasked. The insolvency practitioners have all been tasked to anybody who's trying to liquidate with a bounce back loan, which wasn't used within the trade. And that's the important thing here. If you're taking a bounce back loan and you used it for the rules and the reasons that you were supposed to have done.
Yeah.
So that was, to really, if you needed to take the money out to fund, your your living costs for while you had it, or use it within the trade, or use it for the reasons that they're put out there, you've got nothing to worry about. You can liquidate for that. But if you're taking it to buy a sports car or a yacht or something else, I don't know if you can buy a yacht for 50,000.
I was going to say, what sort of yacht? You buy them for 50 grand, bump for the back.
I don't mix in your circles, Mark. I've never been on a yacht. But if they've used it for things they shouldn't have done, and those are the people that haven't need to really worry about it.
Got you.
So they changed the rules back in December 2021 on liquidations with loans in. And made it that if you've got a bounce back loan, you can't. They've got to then look at the particulars of what you use that for.
Okay.
So if you've taken it and then the same day you put £25,000 into your personal account and then kept 25,000 in the business, the liquidators aren't going to look too favourable on that because they're going to want to know what you're taking that money for.
Yeah.
Okay. So and what would happen? So obviously, if you do liquidate and you've got one of those in there, the liquidator would probably will advise you to pay that back. If you don't, and you haven't used the bounce back loan for what it should have done, then there's a discipline process for that. And ultimately goes back to us looking at disqualification as director, personally liable for the loan.
Oh, so they can do that, can lift like the corporate bail and make you liable for the loan.
They can remove the value of incorporation at that point, and then say, no, actually you didn't use it for what it should have been. And they're giving them extra powers, and they have to report that to their regulatory body, the insolvency practitioners, and has to tell them, look, we've got a liquidation here going through. They've taken the bounce back loan, they haven't used it for business purposes. So and at that point, the regulatory body has to decide whether they allow the liquidation or not, or allow the liquidation and pursue the directors for the money.
Got you.
Okay. Yeah, it's a messy business, to be fair. Obviously, we did a blog on the bounce back loan.
Yeah.
I don't know if you read it.
I did, yeah.
It was quite an interesting read, to be fair. And actually, those new rules, not many people are aware. I think they passed the legislation back in December 2021.
Yeah.
And then it came into force sort of early 2022.
That's it. There's been so many changes, so it's hard for people to keep up.
We say it's about it's changing all the time.
It is. But that's why we do blogs. So check out if you're
blog on the website. Yeah. There's always new topics on there, varying topics. Really, they're not all to do with just accounts and what the tax rates have changed. There's things like that. The bounce back
topical
changes
things,
and
keep yourself up to date.
Absolutely, and that's the thing, isn't it? That's what we put them out there for, ideally. So So when I was talking to the liquidator, we came up with a few things for me to mention here, actually, to
sort of go through
Yeah.
so some sort of interesting things in his world. So, he said about the obviously the bounce back loans have got to be used for correctly. Obviously, if they have been using the business, I said, then obviously we don't want to, scare everybody
it's
and
fine.
say, oh no, please don't. If you have used it for the right reasons and you want to liquidate, that's absolutely fine. Obviously that they're not going to do you for that one. Obviously, I said that they're looking at the regulatory body that they've got to report to for bounce back loans and what they've used for is actually part of HMRC, and actually they've set up separate departments to look at purely bounce back loans and furlough claims when a company goes into liquidation or administration.
Yeah, it's not surprising though, is it? Because they gave up so much money and there's
want to go back.
Yeah, so little checks, so they just want to get it out so quickly.
Exactly.
They're always going to come down and scrutinise, isn't it? And
then go through every, and they are doing stop checks on certain claims, aren't they? We're seeing those come through. We've seen them come through for probably the last 12 months or so now. But even more so, if they'll look at, if a company goes to liquidation, they've got bounce back loans and furlough claims, they will look into what they were. It sounds weird to have furlough claims. That seems so long ago.
Brings back bad memories.
Yeah, it was absolutely nuts, wasn't it? So, and obviously, he also mentioned, to reiterate, that the fact that, insolvency practitioners are expected to look at bounce back loans and furloughs and liquidation to look at, was the bounce back loan used correctly?
Yeah.
Was the turnover multiple correct? Because as I said, people have put £2,000 in and got themselves a nice little sports car. Was it used correctly? One of the banks has teamed up to have a look at whether the funds were used correctly and sort of help from that side of things as well. Okay. So you've got a lot of resource looking at these claims, and you can imagine coming into 2020. What we're doing now is coming into a new year when cost of living's going up.
Yeah,
everything's going up around. One of the key things that I'm hearing about is I don't think I can afford my bounce back loan. I don't think I can afford all these sort of things that have crept up on us. And people are really talking about going into liquidation or whatever. It's not all doom and gloom. Obviously, there are business setups and stuff like that.
Yeah.
But it's becoming a topic we're hearing an awful lot about. So obviously, the furlough stopped in September 2021. Now, how long ago did that feel? Like it was a long time ago. But what they're going to be looking at is to make sure that whether people increase their salaries, to be able to make sure they can claim more furlough.
Got you. So because it was capped on what you were being paid at the time, isn't it? So,
correct. It was a maximum of £3,000 at the time. I think it was. That. Yeah. So what they've so they're making sure that people haven't increased their salaries or changed things to be able to make sure allowed to claim.
Yeah.
And then therefore use the money personally to be able to it's all about them making sure that everything's in the right place.
Yeah.
This isn't something a director has to look for. It's what the insolvency practitioners have to look for, and part of their process is to go through these.
Got you. So how far back would a liquidator go normally then when they're looking at this?
So well, they're not going to look much before the bounce back loan, obviously, and the furlough, because they're the two things they're looking for. So bounce back loans, when did they start? They probably started around about July 2020.
Yeah, it might be a little bit earlier. Yeah. Around that.
Yeah, it was around about then, because obviously COVID, obviously we had lockdown around about March, April 2022. Hopefully not. Hopefully that was happening in 23. Got Mystic Mega.
Yeah.
So it's obviously making sure that we go through it in the right. But go through it. Make sure that if you are going to go there, that all your ducks are in order. Really, you don't want to get to the point where you instruct a liquidator. Going to speak to a liquidator, obviously, first and foremost, they're not liquidating you at that point.
Yeah.
So you can have an honest conversation with them if they're sort of, and then prepare for liquidation. If there is about an overdrawn direct loan account, if your accountant hasn't just discussed that with you, then really, the liquidator will say, look, when you're going to liquidate, make sure that, or if we were to liquidate today, you'd have to pay back 16,000.
Yeah. Or
whatever it is. So therefore, if you have got an overdrawn account and you are going to go into liquidation, you need to be aware of those sort of things. And that's why those conversations happen. And actually you might think you're an insolvent company, and actually you're not. Yeah. When they look at it, they might say, well, actually, no, you're a solvent liquidation, which makes, obviously, I assume I'm not an insolvency practitioner, but their sort of things different.
Yeah.
But they're still going to look into bounce back loans and all those sort of things. It doesn't suddenly go away. But it's something we're hearing quite a lot of. So it's just something we've got to go through.
and be aware of, really.
Yeah. Okay.
And don't be scared of it.
Don't be scared of it.
Don't be scared of
You
it.
scared me. You threatened me with prison area and fines and all sorts.
Well, yeah, only not in the right way. If you're doing it for the right reasons in the right way, and you actually structure it in the right way, you'll be absolutely fine.
Yeah, but if you're thinking of doing it, you can come and speak to us in the first instance.
Yeah,
as well.
Yeah. And we work with a lot of, with a lot of professionals, not just liquidations, with a lot of things. But
because obviously we've already got that relationship with our clients, so we can have a conversation with you about how it could work, and then point you in the direction of a liquidation.
At least give you an idea of where everything's going to sit, and then and it's just making generally when people think of liquidations, they think of a company is failing, it's not a very good business, it's all it's all doom and gloom. And actually, some of them just and I was speaking to him the other day, and I asked him about whether it's people not performing in business and they go in because they've got no money.
Yeah.
And actually it's a strong mix at the moment. People are restructuring their businesses, so therefore they've got branches they don't need anymore.
Yeah.
Or they're consolidating their interests, or actually some of them are obviously businesses, their trades disappeared. Right. You can imagine after COVID, things have sort of boomed a little bit and have come back down again. So we're all
Could it be people retiring as well?
Could be people retiring. Yeah. Good point. Yeah. Where there's no succession, no one's taking over the business, so they're just going to
naturally come to an end.
So it's not all doom and gloom.
With business going to be a bad thing. Yeah.
You mentioned insolvency practitioner, and all of a sudden everyone gets a bit scared, but it's not. It's same as us. We do it with many different situations, scenarios, reasons. So it's all just going through why.
Got you. Well, I've learned quite a lot there, Neil. I don't think I've got any more questions.
Got no questions?
I don't think so.
You're
sweating a bit. No. I've learned a lot there. But...
You can tell I'm an expert on this, can't you?
Yeah.
Well, it's like you on your topics that I grill you on.
Yeah, that's it.
I'm surprised you haven't grilled me as hard as I expected, though.
No. Well, I'm hoping it'll mean you'll go easy on me in the future. I mean, probably won't.
I can't promise on any of these things, to be fair. But okay, I'll try and go easy on you anyway.
No, you do, to be fair. It's all about getting the information out there.
Absolutely, and there's no point having you have the information and not sharing it.
Yeah,
exactly. So I coax it out you sometimes. But yeah, that's everything on liquidations. But if you have got any further questions about the VAT or about the liquidations, please contact us on
01905 777 600,
and they can phone us or they can WhatsApp us, can't they?
WhatsApp.
Absolutely. Well, WhatsApp has been actually quite busy, to be fair, recently, which is nice. So we'll have loads more questions for future topics that we've got coming up.
That's it. Yeah. If there's anything you want us to discuss, let us know. Thank you for listening today, and thanks to our special guests, our VAT experts, and our very own Neil Sager. I hope you've learned as much as we have on VAT and the insolvency. Next time, we're going to be looking at apprenticeships and more with our HR experts. If you've got any questions you want on that, feel free to WhatsApp us. And what's the number, Neil?
01905 777 600.
That's it. Until next time, thank you very much.